What's up, everybody? Welcome back to the Contrarian. Now, market sentiment is very bearish right now, anywhere from hedge fund managers to individuals out there, institutional investors. They're all very bearish. At least that's what the majority of headlines out there seem to indicate. That's what fear and greed indices and measurements of this seem to indicate. And I'll be showing you a couple of charts today which really amplify this and show that investors are in fact extremely bearish right now. I'll also show you another very interesting chart that I found out there that essentially signals that we could be very close to the end of the current bear market that the general equity market, the stock market, has been in for the entire year of 2022 so far. Now I'll preface all of this with a brief disclaimer saying that obviously this could be wrong. Obviously the bear market could go on more. But this is very interesting data to look at nevertheless, because it does really just show how we could be very close to a key moment in terms of sentiment never being quite as low as it is right now, at least for the last few years. So both of these charts that I'll be showing I found on SentimenTrader's Twitter page. Now, SentimenTrader, in my opinion, is very worthwhile to follow on Twitter. I found some very helpful just things that have helped me to put things in perspective out there. But the first thing I'll talk about is just how bearish people are. This SentimenTrader put out on September 7th. Sometimes there's a chart that just blows your hair back. In 22 years of doing this, none stand out like this one. Last week, institutional traders bought 8.1 billion worth of put options. They bought less than 1 billion in calls. This is 3 times more extreme than 2008. And then looking at this chart, you really see how rapidly it accelerated just in the last couple of months, if not the last couple of weeks, to the downside, of institutions hedging to the downside like never before. Now, my guess would be that this chart would be a little less extreme if you were to say take into account the market weight of the entire equity market. This chart would probably look a little less extreme, but if you go, for example, between 2008 and 2020, even between those two extremes, you have somewhat of a constant, as well as in the later 2016. And then suddenly here in 2022, it really falls off of a cliff to the downside. So it does show that institutional investors are extremely bearish out there, and they're definitely wanting to hedge to the downside. They see a lot of value in hedging to the downside, and they're willing to pay a lot for put option premiums to hedge to the downside. So the market is in fact very bearish right now. This is likely for a variety of reasons, but the market likely believes the Fed will continue to fight inflation significantly going forward. The market also realizes that the Fed has actually put major brakes on the economy, and because of that, earnings and everything that companies would be normally expecting to come in, that investors likely were previously pricing in, they're likely pricing in a much more contraction in earnings as a result of the Fed tightening. So now looking at another chart that SentimenTrader retweeted on July 19th, so a little further back from now, but this guy, Jason Gopher, I hope I'm pronouncing his name correctly, but Jason is saying the bear market is over. In modern markets, the S&P 500 has never lost ground over the following year when advancing volume was 87% or more of total volume for 2 out of 3 days coming off a 52-week low. It has a perfect track record. So looking at this chart, you can see that all of these red dots indicate criteria, days when volume was greater than 85% of 2 out of the 3 previous days after reaching a or within 30 days of a 52-week low. So each time after you make a new yearly low, all of these red dots are days in which that criteria was met. So you have volume that's greater than 85% of 2 out of the 3 previous days. So you can see where the market rallied significantly after each of these criteria was met. I think most significant we can see back in the Great Financial Crisis, when there were multiple days, likely at least 10 or something back there, but it signaled when it was very close to bottoming. It did signal probably 6 months prior to actually reaching the bottom back there. So it is important to note that this indicator, it likely indicates when you're close to the bottom, but definitely it's not spot on when the bottom is reached. So this is a very interesting chart to look at nonetheless, because it does kind of indicate that if the chart is correct again, which it has actually been 100% of the time so far, there is no major deviation from this trend. But if it's correct again, one would think that in the next, say, 6 months, market sentiment does change very dramatically from the extreme bearish level that it currently is to being more bullish. This might not come, or it definitely almost could not come from a reversal in the economic downturn we're currently experiencing. It could come from something like a Fed pivot occurring. At this point, the stock market, the real economy are very bifurcated. They're very non-correlated with one another. So as strange as it might sound, even if the current recession does continue, even if GDP comes in negative for the third quarter and the fourth quarter, even in that kind of a situation, if the Fed does pivot from their current tightening cycle, and as a result of that, if investors become much more optimistic, simply because money becomes much more cheap than what it currently is, you could see a significant reversal to the upside from where we are right now, simply because investors have acted so significantly on their bearish opinions. They have hedged like never before to the downside. And so even in such a strange situation as this, during a recession, to experience a strong stock market, it could actually occur. Now, obviously, trends can and are often proven incorrect. Nothing over the extremely long term has a perfect track record. It just so happens that this track record of this particular chart hasn't been broken yet. It likely will be at some point in the future, but it is very interesting to look at the more psychological side of markets, how currently investors are very skeptical, very bearish of the markets, and they've hedged like never before to the downside. But it does go to show that when that does reverse, as it does in the past, as it has reversed in the past, it does lead to significant rallies off of that low. So all of this being said, let me know what you guys think about these two very interesting charts by SentimenTrader down in the comment section below. If you liked this video, just consider subscribing to the channel, giving the video a thumbs up, and I hope to see you all again at some point.